This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Lane Kawaoka, creator of SimplePassiveCashflow.com. Lane's passion project, SimplePassiveCashflow.com, is a top 50 investing podcast and free resource for passive real estate investing. Working as a high-paid professional in corporate America and frustrated by the traditional wealth-building dogma, Lane was compelled to inspire and mentor other working professionals on how to do real estate investing and build their own portfolios. Lane urges other working professionals just getting started by utilizing their highest and best use time to save down payment money to acquire a single-family home rentals. The simple passive cash flow method is to only buy investments with a healthy cash flow buffer that can withstand a market downturn. Lane has gotten so much appreciation for his work via these kind words from his audience. Lane, thank you for joining us.
Hey, thanks for having me, Hall. Aloha, everybody.
Great. So tell us more about how you got into your current investing in appreciation markets.
Yeah, so I kind of had a linear path of, I grew up pretty frugal. My parents taught me to go to school, get a good job, and work at that job for 40, 50 years, buy a house to live in, all that traditional wealth building stuff that I don't necessarily agree with, and what I kind of help educate people kind of to live how the wealthy do. So my kind of story, I became an engineer, graduated, started working for a couple of years, saved up to buy a house. But because I was never home, and I was working on the road all the time, I just decided to rent it out. So for a young 20-something-year-old kid, the rents that I made well exceeded the mortgage payment. And that was a lot of beer money to me at the time. But then I quickly realized if I just kept doing this, I'll be able to escape the rat race. And that's what I kind of set forth to do shortly thereafter.
Well, great. And so you have a set of counterintuitive wealth rules, the ones the rich people follow. Can you walk us through that and tell us more about that?
Yeah. So first one is don't buy a house to live in, right? I personally rent here in Hawaii. And a lot of your money is going to go further investing in assets or rental properties. And I think for most people, I would say it would probably be good to buy a house because buying a house is kind of like a forced savings account. But for a lot of us, that are kind of improving ourselves, listening to podcasts, I have a hunch that you guys are pretty good with your money, and it's probably better to invest it in the long run.
And so you say don't buy mutual funds or other Wall Street products. Why is that?
Well, I think, they're retail products, right? I mean, you can invest in a REIT that happens to invest in real estate, but a lot of these products, there's just so many middlemen, right? The financial planner, they get paid when they sell you commission-laden products. And even though the expense ratio might be very low, there's a lot of hidden fees in there. I mean, I think that's why a lot of, your folks will invest directly with a sponsor or operator. Same thing with us. Either we're doing it ourselves, buying our own rental properties, or investing in syndications and private placements directly with the operator.
And so what's your take on using retirement accounts?
Yeah, so, in our world, we try not to use retirement accounts for investing. I mean, 4 big reasons why. Number one, a lot of people doing this can get financially free in 10 years. Therefore, you don't want to wait till the 65, 70 years old age where you can take out the money. Right. I was doing this maybe for a dozen years before I quit my engineering job. And so, yeah, that's kind of point number one. Point number two is, look where your tax bracket is today. Most financial advice is predicated on you're going to kind of retire, lose your income, and be in a lower tax bracket. But I don't know about you, Hall, but I anticipate my taxes, the amount of money I'm going to make in the future to go way up. Therefore, my tax bracket is going to go way up. So pay taxes today, get it out today before it goes up. And then, just where is all these government entitlement programs? $3-4 trillion just getting pumped in the system. How else is the government going to pay for that than raising tax brackets in the future? But, something that passive real estate investors kind of know about is a lot of these deals, you get a lot of depreciation, paper losses, or passive activity losses to also potentially offset your ordinary W-2 income. Now, you don't get any of that if you're investing within a retirement account. This is why a lot of times we advocate for just investing cash. So you can use those passive activity losses to kind of manipulate how much taxes you pay.
So how does one get started? If you're a working professional, how do you get involved in, say, passive investing? What would you do to build that up?
Yeah, so kind of two ways of doing this, right? Like, I mean, I think when most people think of real estate investing, they think of house flipping, or they see an HGTV. All that stuff is a job, right? I had a good paying job, and a lot of my clients do. A lot of them are doctors, lawyers, engineers. And once they get going, their highest and best use is at their job. So they want to invest passively, as little as time as possible. But to do that, you need some money, right? This is real estate investing. So kind of the two big populations I work with are the lower net worth guys, under $250,000. You don't really have access to bigger deals. So you got to do what I did when I got started, just buy rental properties for cash flow that are 1% rent to value ratio or higher. But if you're an accredited investor, just like investing in startups, find a bunch of sponsors, build your network within the real estate community, and invest in deals, right, as a passive LP partner.
And so how long does it take to build up a portfolio? What kind of time frame does it take to get sizable gains on it?
I mean, a lot of the good thing about real estate is it's backed by a hard asset. It's not like a bunch of digital assets. And at the end of the day, you're investing in something that America has a demand for and a growing need for. We have a growing population. And especially, we invest in workforce style housing. So our rents are typically in the $700 to $1,200 range. Not the luxury stuff, not the low end stuff, right in the middle. And I think this country needs more of it. And I think they appreciate the good value that they're getting. Now, when you invest in that type of stuff, you're investing in the bell curve of where the population is. Now, how long does it take to get set up? It could be as quick as you want, right? It's how much money can you gamble in Vegas, right? If you want to go real big, then you can blow your money real fast. But I guess what I suggest is people not really investing in any one deal with more than 5% of their net worth. So most times people will invest, 50, 100 grand, if their net worth is over $1 million into one deal, and they'll diversify over a few dozen deals. So they'll space out these opportunities. And a lot of these deals, or at least the ones that we go into, they're stabilized assets, they're cash flowing already, they're 90% occupied. So, they're good businesses, but there's some kind of value add. So we'll go in there, usually rehab the units, maybe put $4,000 to $6,000 or rehab into each unit, new flooring, new appliances, but not really get into the big stuff, just kind of lift up on a pig essentially. But with that, we're able to bump the rents up $100 and get great returns via forced appreciation. So a lot of that is, we're not kicking tenants out. We're just, as a natural turnover happens, we go up there and rehab the units as we balance cash flow. Right? We don't want to kick out tenants because we want to keep our cash flow high in the interim. So, that will probably take a couple years, 2-3 years to kind of cycle through most of the units. So it's kind of like a slow flip. But the nice thing is if the economy takes a stumble here or there, you're still cash flowing in multiple exit strategies.
What's it like to manage these properties once you have them up and running and you have tenants in there? How do you, manage this, all this activity?
Yeah, when I had 11 rentals and kind of did it by myself, I had all these property managers to do it. Right? And if you're buying a single family home rental and you're not a broke guy, that's what I would suggest, right? You pay these guys around 10% of the income and they manage it professionally for you, and you don't have to worry about tenants, termites, and toilets. Now today, we buy apartments. So we work with commercial property operators. We pay them on salary. We have better metrics and KPIs for them to keep for us. But, we kind of play the role of asset managers. So passive investors, quite frankly, don't do anything other than read a few reports on a monthly basis here or there, just trying to keep up if they're interested. If they're not, they don't need to read it. But yeah, those are kind of the two ends of the spectrum as far as passive investing.
All right. So you run your own podcast. Can you tell us more about it?
Yeah, so my podcast is Simple Passive Cash Flow. I started back in 2016, and at the time I was still buying turnkey remote rentals, and all my buddies were asking me, well, how do you do this? Because you've been doing this for almost a decade now. And of course, I think all of us investors will agree that we tell our friends and our family like what we're doing, but very little people do it, and there's frustration there. And so I was frustrated. I would waste my time explaining this stuff over lunch. No one would ever do it. So I just recorded the damn thing. So a lot of the first dozen podcasts were all about buying single family home remote rentals. I was buying in Birmingham, Atlanta, Indianapolis. And yeah, I wasn't visiting these things. And there's ways to get around it and build a team so that you don't really have to visit the properties as a passive investor. But at that time, I was becoming more of an accredited investor, and I started to discover these private placements and syndications, investing in larger, more robust deals. And throughout the years, 2017, 18, you can kind of see the genesis as I became more of an accredited investor. So my podcast is kind of a follow my journey to today and beyond.
Well, great. And so what have you learned from the speakers on that podcast? I'm sure they have lots of great ideas.
Yeah, I mean, a lot of it has come from, me joining different masterminds and, getting around other high net worth investors as far as like, a lot of the tax stuff. I mean, I don't pay any taxes today because I'm smart. I use my passive activity losses to drive down my ordinary income and passive income. I think that's how we first got connected. The startups is kind of cool to me, right? It's investing directly with the operator, cutting out all the middlemen. But the real stuff can get a little boring, right? The returns, I mean, maybe at best you're doubling your money every 3 to 5 years, and it takes a while. And with all the taxes I save, there's more money to invest. I think that's the appeal to the startups. It's a lot quicker, rebound rate too. But, I think where real estate has an advantage is the tax efficiency and the ability to pay less taxes if you're still working your day job. And in this world, you start to discover and you start to interact with a lot of other people, and you start to learn about other tax strategies like land conservation easements, solar deals, oil and gas deals. And then, a lot of it has to do with like building your own irrevocable trust system, right? Like, what are the high net worth families doing? The guy's $100 million and above. Well, I'll tell you, they're not doing anything that tricky, but it is very counterintuitive to what the average person, certainly what my parents taught me. We'll do infinite banking where we use a whole life product, but we overfund it so we can kind of bank from ourselves, things like that.
So what have you learned not to do from this group of people?
Yeah, so sophisticated investors, they don't worry about interest rate or amount of debt, right? They care about what their cash flow is so they can hold on to the asset in case of hard times. And they care about what their net worth is happening, or what I call return on equity. But you always need to keep your money working for you. And a good case in point on that is don't keep money in your house as equity. It's not doing anything for you. It's dead equity. And from a litigation or asset protection standpoint, I'm not giving any legal advice, but having money, all the equity in your house is probably the dumbest place to keep it, because you're a sitting duck. Everybody knows how much you have in there. I mean, sometimes debt is your best deterrent from a lawsuit, encumbering yourself with that debt. And then why would you not want to encumber yourself with debt? Because that's what the government does. That's why the government has so much debt, because they know that as inflation comes, their debts kind of get smaller by relation. So very different concepts than what your parents taught us. But, if you don't believe me, run the numbers yourself, right? Numbers don't lie.
So how do you vet a syndication deal or a private placement, as a limited partner? How do you know it's a good deal or a bad deal?
Yeah, so I mean, me personally, I'm able to underwrite the deal and, using the rent rolls and the profit and loss statements. And I'm able to put it into my model and kind of see if it's a good deal, run it myself, and kind of do some comp analysis on other assets and what they're renting for. But most passive investors, quite frankly, don't know how to do that. And I think as you and I have kind of discussed, how like most, startup investors, they quite frankly don't really know that particular business's niche, and they're not the technical expert on it. I think real estate's a little bit easier to do diligence because it's all right there in the numbers, and it's pretty basic, right? Everybody's rented an apartment or a house or owns a house, right? We all kind of get it, and it's something understandable. But, all that aside, right, a lot of it is just vetting your sponsor, But in my opinion, the best way to do that is to build your network of other passive accredited investors. And that's what I've kind of created. The Huido Pipeline Club is kind of my group. And I also have a mastermind behind closed doors of other high net worth accredited investors, kind of sharing best practices for financial tactics and who to work with, right? Who are the shysters out there? Who are the people to stay away from?
Absolutely. And so, passive cash flow investing, you got all these passive streams of income, and, you're not doing it the traditional way. But what do you think is the next step here for someone that wants to get involved with it?
Yeah, I would say, just like anything, you try it out, right? When I was investing in Seattle and I heard about these remote rental turnkey properties at Cash Flow in Birmingham, I bought one, tried it out, and then I jumped in, right? I deployed more funds. Same thing in this case, right? Like learn about it, learn about syndications, meet a few people, but eventually you're going to have to jump in. Put some skin in the game. I'm kind of doing that with Bitcoin, even though I just think of it as more of a fun thing. But unless I put money in it, I quite frankly don't really put too much effort into learning it. But I think at that point, you sit and wait and you see if the operator performs before you deploy more serious amount of funds.
So what's the max 5% net worth rule? What does that mean?
Yeah. So as an investor, you want diversification, I believe. So, when you're investing in syndications and private placements, you do give up control to your operators and what's happening. And for some people, that's a good thing because you might be the worst person to operate this asset. But you want to be diversified with different partners, different geographic locations, different asset classes. I kind of specialize in multifamily apartments, but you might like mobile home parks, self-storage, assisted living, triple net commercial leases. There's a wide breadth within the world of real estate. I'm trying to diversify outside of real estate personally, right? I think that's how we got connected. But, in any one deal, I try to stay below 5% of my net worth.
That's an important point. So a lot of people want to use their 401k. How do they do that for getting involved with passive cash flow investing?
Yeah, I mean, before we start to rate our 401ks, which is sort of an irreversible thing, when I start to do a consult with a client, we're looking at other sources of liquidity first, such as do they have liquidity in their bank accounts? Most people, if they're good investors, they don't have too much cash sitting around making jack, right? Then at that point, we start to look at, all right, do you have any equity in your house or any rental properties that you may want to sell, right? But after that point, yeah, we got to go look at your retirement funds. And when you take money out of your 401k, you haven't paid taxes on it yet. So when you take the money out, you're going to have to keep in mind that you're going to have to pay the taxes on that. If it's a Roth, you can take out the contributions tax-free. And you can take out the money out of that because you've already paid the taxes on it. So that's another thing to keep in mind. But, just take a situation where you have a 401k guy. If they're in a lower tax bracket, like they're making under $330,000 AGI or adjusted gross income, we'll kind of take it up to that magic number because $330,000 is that blend between that 24% to the 32% range. There's quite a bit of jump right there. So that's kind of like that magic waterline. If you're under there, we try and take just as much out of that 401k to get you up to that point. So good example would be, a guy making $200,000 a year, AGI, married filed jointly. They've got several $100,000 in their 401k. So we may make a plan for them to maybe take out $130,000 or leak it out slowly so their AGI doesn't blow up on them over that $330,000 mark. If it does, no big deal, right? Because we have a progressive tax system where they're only taxed at the higher rate for that overflow. Another example, and this might resonate more with your folks is, I have a lot of doctor clients that might make $600,000 a year, right? At that point, they're going to get beat up as they take money out of the retirement account. So that we may elect to do a solo 401k for them so they can self-direct the assets into real estate. Or some guys are just like, screw the stock market. I'm over that. I want hard assets that I can control, that I understand. So at that point, we may look at some more exotic options, such as land conservation easements, to mitigate that AGI bump.
Great. A lot of great ideas there. In the last few minutes that we have, what else should we cover that we haven't?
Yeah, I think there's definitely a prescription out there for high net worth investors, and it's really not that hard. There's definitely the basics on taxes and, investing. A lot of stuff out there is on my website for free. I would suggest taking a look, listen to my podcast. And if anybody has any questions, my email is lane@simplepassivecashflow.com.
Great. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Yeah, appreciate it, Hall. Thanks, everybody.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.